Okay, everybody, let's get started with chapter 21. Okay, this chapter today, well, today, tomorrow, we might even be done, possibly by tomorrow, I'm not sure, but we'll probably done for sure on Monday. And then we'll start 22, and that'll be it. So, I mean, the school year is coming to a close pretty quick. We have this week remaining, next week, and then, like I said, I want to give you the exam for all your classes with mine by about the 3rd of June. Okay, so that'll give you about 8, 9 days to complete and get back to me so I can mark your grades in. All right, so let's start with chapter 21. So dealing with accounting changes. Okay, so when why do we need to make an accounting change? Okay, so first of all, accounting standards attempt to establish consistency of financial information, okay, in the face of an inconsistent accounting policies by requiring retrospective application of accounting policy changes. Okay, so basically, what are they trying to state there? Well, we have accounting standards. Okay, so we have these standards that are in place for consistency. Why? Because we want to be able to compare prior years to the current year. Okay, so as a result, if we change our policies in order to keep that consistency, we have to restate our prior year's numbers. Okay, so that's the gist of it. Now, it gets a little bit more trickier because we have various types of accounting changes, and we don't always have to restate. So while restatement is ideal, it's often not possible. Why? Because the information is too hard to get. Okay, so this chapter is going to explore the ways that accounting policy changes are reported and the circumstances that govern each approach. Okay, so as well, the changes in estimates and corrections of errors will also be examined. Okay, so we have 3 types of accounting changes. One is estimates. Okay, so we might go and change our accounting estimates. Okay, now we also have changes in accounting policy. Okay, these are close, but they're different. Okay, and then there's different treatments as well. And then we might have error corrections. In 15 years of public practice and being a CPA, I have maybe done 2 or 3 error corrections. They just don't happen. So if we go back to our auditing class, it kind of ties in because if the error is small, okay, so or immaterial, we're not going to bother to make that change or that correction. Okay. So let's look at the first type of accounting change, and that's a change in estimate. Okay, so this is on page 1486. So we're going to go from 1486 to page 1490 today. Okay, so with a change in estimate, okay, a change in estimate is a change that in accounting estimates that arise when management revises assumptions used in the past, given new information. Okay, so what's an estimate? Well, examples would be uncollectible AR. Okay, so maybe in the past for AR we used 2% of sales. Okay, if that was inaccurate, well, maybe we need to change our estimate. Maybe that estimate now needs to be 4% of sales. Okay, again, it's not a policy; it's an estimate. So if we change estimates, that we've got to understand what the end goal is. Okay, so again, an example of estimate changes would be AR, so uncollectible AR, which leads to bad debt, inventory obsolescence, okay, estimating the fair value of financial assets, probabilities. Okay, we don't know if we're going to win a lawsuit or not. Okay, there might be we might have to take a weighted average of what we think that liability might be. Again, it's an estimate. Okay, now also we might have a change in our depreciation estimate. Again, maybe we think it's going to last us 6 years, But the next thing you know, we're really beating it up and it's only going to last 3 years. We're going to have to adjust that estimate. Okay. So that would be examples there. Okay. So we got to remember when we deal with a change in estimate, okay, these changes can occur for several reasons. Why? Well, there's new reliable information available. Okay? So in this case here, when we're changing our depreciation rate, well, that new information is, well, we've now used it for a couple of years and it's just not going to last 6 years as we thought. It's only going to be 3. Okay? Or maybe we have experience as well. Experience will provide insights into usage patterns and benefits. Okay? Maybe the company's economic environment has changed. Okay? So they're going to have to adjust all these estimates. A shift in the nature in the company's business operations. Again, anything to do with an estimate change, okay, will need to be recalculated only for the current year. Okay, so what that means is changes in accounting estimates are accounted for prospectively. Prospectively meaning by applying them only in the current and future periods. So let's just say we're looking at the 2020 year. Now, with 2020, up until this point, we were doing a straight line depreciation. I don't know, just say a piece of machinery. We were straight lining it at over a 10-year period. Okay, we get new information. It's only going to last us 6 years. Fine. Okay, so we're doing 2020. Okay, we're in the 2020 year. We're not going to go back and adjust 2019, 2018, 2017. Okay, it's a prospective change. Okay, so it only gets applied to the current and future periods. We don't have to go back and adjust prior year. We always prefer that accounting estimate be a change in estimate. Why? Again, you don't have to go back. If you have to go back and restate prior years, it can be a little bit difficult. Okay? So all we want to do then is let the reader know, disclose it. So we're going to let them know the nature and the amount of change in an estimate, okay, for the current and future periods. Okay, so useful life. So we're going to drop it from 10 down to 6. Okay. So again, nothing, it's an accounting change, but it's a change in estimate. It's fairly simplistic. Okay, we like this one, or I do anyways. Okay. So before we get into accounting policy, okay, we've got to decide, is it a policy change or is it an estimate? So the application method for a policy change and a change in estimate are different. Okay? So policy changes are applied retrospectively, so they go back. So not only do we have to adjust the current year of 2020, we have to do 19, 18, okay, to the start of that era, or sorry, to the policy change that it affects. Okay? So again, I'm just going to mark this up here. Estimates, prospective. So current year and forward. Okay. Now, when you have a change in policy, that's where we really got to figure out, okay, is this a change in policy? So policy changes are applied retrospectively, okay, while estimate changes are applied prospectively. So again, this is our current year. For prospective, we only adjust 2020 and beyond. If it's retrospective, we have to go back. If we don't want to go back, it's hard. Okay, so when it's difficult to decide whether a change is a change in policy or estimate, the change should be treated as a change in estimate. Okay. So let's look now at characteristics of policy change. So a policy change is the change in the way that a company accounts for a particular type of transaction or event, okay, for the resulting asset or liability. So maybe they start to record sales differently, okay? So that would be a accounting policy change. So accounting policies, they can be mandatory or voluntary. Mandatory changes are when the standard setters issue a new accounting standards or they revise an existing standard, where a voluntary accounting change, or sorry, a voluntary accounting policy change is where management decides to make a change from one acceptable method to another method of accounting. Okay, so again, but with that voluntary change, okay, the company has to prove that there is some sort of benefit. Okay. So with a mandatory change, okay, just say mandatory. Mandatory change is caused by the application of new or revised standards made following the transactional requirements of the new or revised standards. So usually these are retrospective. Okay? So when you make a retrospective change, it's as if the policy was applied as if though it's always been in effect. So that's why you're going to restate. Okay? You're going back retro. Now, sometimes with a mandatory change, okay, a prospective treatment is allowed. Okay? Meaning, the new policy is recognized only in the current year and in future periods. It's not applied to earlier periods. So we like that when we only have to make a prospective change. Okay. Voluntary. So a mandatory change can be either retro or prospective. It really all depends on the amount of information we have. If we don't have enough information, okay, we can only do that policy change and the effects going forward. Okay, so that'd be prospective. Now, why would we have a voluntary change? Okay, well, the reason why is, okay, it's more reliable. So remember, when we're the company, and we decide, well, we want to make an accounting policy change, it has to be more reliable as a result and more relevant, okay, for those financial statement users. Okay, so the statements are the effects of the transactions or other events on the entity's position, financial statement, financial performance or cash flows is why we would do a voluntary change. So again, management may make a voluntary change in accounting policy in response to changes in control. So basically overall reporting objectives, okay, a change in the way the company is doing business, or maybe they want to conform to industry practice. Okay. Now, you can also do an early adoption. So if there's a mandatory policy change that comes into place, okay, by say the CPA Canada says you have to do a certain type of transaction this way. Well, that's mandatory. Okay, so some companies may adopt or choose that policy early. Some will do it on the deadline date or the date becomes mandatory. Okay, so the reason why you might do early adoption, okay, is to promote comparability and give time. Or sorry, the two reasons why you would not want early adoption as well as to avoid the work, promote comparability, okay, and give time to collect the data. Okay, so usually these change are 1-2 years in advance. So again, a new policy is not always a change. Okay. So adopting a new accounting policy must not be confused with a change in accounting policy. So the following are not changes in accounting policy, okay, so we've got to be aware of this. Okay, and this is on page 1489. Okay, so 1, adopting an accounting policy for transactions or other events that differ in substance from those previously occurring. Okay, so that's not a policy change. And adopting a new accounting policy for transactions or other events that did not previously occur. Okay, so if you bring in a new policy for another type of sale, and you didn't have that sale to begin with, well, that's not a policy. That's not a new policy. It's a new policy, but it's not a change. That way you wouldn't change those numbers. You wouldn't have to go retro. Okay. Now, when we do a retrospective change, so we find out that we had a policy change, it was mandatory, we've got to do retro. Okay, so we've got to go back. So changes in accounting policy are accounted for retrospectively by applying them to all prior years. Okay? So let's just say that instead of doing depreciating an asset, that'd be an estimate. Okay? But let's just say that we had sales, and for sales, we, as a result, for the current year, it increased our sales by 20%. Okay? So we'd have to go back and find out how that new sales procedure affected prior years and make those changes. Okay? So again, policy change is a retrospective change for the most part, unless we don't have enough information. Then we'd only do it prospectively. Okay, so if a company is not available for full retrospective restatement, the company has little choice but to apply prospective treatment, okay, where the impact of the change is calculated as of the beginning of the current year, but they don't change the comparative years. Okay? You let the reader know that in the financial statements as well. Okay. So, still dealing with accounting policies, the use of prospective application is quite restricted. Okay, why? Because they don't want you making that policy change and just going forward with it. They want to let the reader know the effect of the prior years. Okay, so if a company does not have the information necessary to restate at least the prior year's results, the change normally should be delayed for 1 year, so necessary information can be accumulated to make a smooth transition. And voluntary changes should always be made only after sufficient information has been obtained to restate the comparative numbers. Okay? So again, if you're going to make the change in policy, great, do a retro change. But in the real world, you want to do the change for the current year, so prospective only. But again, accounting rules state that we must do retro if it's a policy change. And then if we don't have enough information, then it could be prospective. Lastly, we have an error correction. Okay? So prior period errors are omissions or mistakes made in the application of accounting policies in earlier periods. So mistakes can be mathematical, they can be oversights, okay? They can be misinterpretation of fact or intentional fraud. So errors relate to information that was available when the prior period's information, financial statements were prepared. So again, they found out we made an error and there's information to back it up. It's not as if you can't go and say, okay, well, we found an error from last year, but we didn't have that information available last year. So again, the error has to be related to information that was available when the prior period's financial statements were prepared. Okay? And two, okay, it relates to information that could reasonably be expected to have been obtained and taken into account in the preparation and presentation of those financial statements. So if it's a little bit bitty piece of information that no one would have had access to, you can't really count it as an error. Okay? So what do we do when we find, well, let's look at some examples, okay, of an error. Management discovers a portion of inventory at the beginning of the year that was not included in the physical count. Okay? The company fails to accrue commission liabilities on sales prior to the fiscal year. Okay, so those are easy errors that we can go make prior period adjustments as well. Okay, and routine repairs to equipment were capitalized instead of expensed. Usually those are going to be so small you wouldn't restate anyways. But those are some examples of error. They're just blatant mistakes, okay? And they happen. Okay. So errors do not arise from change in policy or estimate. Okay. What we want to do is, with the correction of the accounting errors accounted for retrospectively with restatement. Okay? So again, we're going to restate the financial statements of the current year and the prior year. Now, the error should not have happened, okay, which means that the statements for one or more past periods were simply wrong. Now, usually eventually they'll self-correct themselves, okay? But if you find the error, you want to correct it as soon as possible. That would be called a counterbalancing error. So most changes flow through retained earnings at some point. Remember, that's what's left over after net income, opening retained earnings, your net income minus any dividends. That's what's left in equity. Okay. So when the impact of the change is washed out, no entry is required to the current period's statement. Okay. So if you make an inventory count error in the prior year and you get you do the proper count this year, well, it's a wash. Okay, it's washed out. Again, inventories that correct 1 year after. Why do they wash out? Well, because if you're short last year, you're going to be over this year, and over a 2-year period, it's going to balance out. Okay. So that's a wrap dealing with the basic types of accounting changes. Okay. Estimates, policy, and error corrections. So what I'd like you to do is I've assigned 2 questions. One recalculates your depreciation And the other one gives you about 5 or 6 scenarios that you're going to have to decide what type of accounting change is it, an estimate, policy, or error correction, and then how do we are we going to restate it retrospectively, okay, or are we just going to do a prospective change? Okay, so that's it for today, and we will talk to you tomorrow.